Meta just released their Q1 2026 earnings earlier this week, and the stock saw a 10% drawdown directly after that. Given that this is my largest holding in my portfolio, I currently hold around a little over 30 shares, so you can do the math on what that works out to. I want to go through some highlights I noticed in the earnings call, as well as the presentation and the press release, the good, the bad, everything that I thought was important to me. So, first thing we're going to start with is we're going to go ahead and to jump into some of the main numbers within the press release that we can touch on, starting with the revenue for the company. So revenue, this was one of the positives of the company, with revenue accelerating 33% year over year, which is insane. So going from 42 billion to 56 billion, which is kind of crazy when you're thinking of the amount of growth a company of this size is happening, going from 42 to 56 billion. These are some insane numbers, and it's an insane size just on a total number basis. So to be growing 33%, very strong growth. I think this is kind of showing that some of their AI and CAPEX spend is starting to pay off. Of course, we need to see this accelerate quite a bit more, I think, for the market to kind of reflect it and be okay with the CAPEX spend, which we'll get into more in depth in a second, but that is going to be one of the main reasons the stock price, I believe, is down so much. So another thing, so the cost and expenses up 35%. We don't want to see this up higher than revenue, which it currently is right now. If they're spending all this CAPEX and they're upping their expenses, ideally, we'd like to see that cost and expenses be lower than revenue. If it stayed at a 35 and revenue was up at a 37% or 36%, it would be fine. But right now, they do need to get the costs in line. But I'm personally not too worried about it. Zuckerberg in the past has gone crazy with the spend. That's how you got the drawdown of the stock price whenever I made my big initial position back in 2022. That's how you got the stock dropping from in the 300s going all the way down to, I think it bottomed out at, I believe, I want to say it was $88 a share. Around there it bottomed out. So yeah, he's gone crazy with the spin before, so he's able to pivot on a dime if the stock price gets hit enough. I'm not too worried about that. And then on top of that, he's one of the few CEOs, I'd say, or one of the few management teams where I do hold more trust in him, because he's proven he can deliver. He's more of a visionary. He can deliver on his promises more than he doesn't, if that makes sense. For example, growing Instagram, spending, what was it, like 1 point something billion back when they bought it, and now Instagram, with how much it produces alone, easily, if it was trading by itself, standalone from the family of apps, it'd be definitely a valuation of hundreds of billions. So he's one of the few people who I think is such a visionary, the founder of the company, that I'm okay with them going with the spin. And even if I may not see his game plan short term, I have conviction that his game plan or his vision for what the company is going to go towards is going to ultimately be the correct decision. You don't get in the place building one of the Magnificent Seven companies if you don't have that visionary mindset. At least my thought process. Obviously, you are open to your own interpretations, and so is the market, which is why the stock price can be down. Now, next thing we note, we had net income up 61% and diluted EPS up 62%. However, this is very misleading, which is why I put the true one right here. So this is due to the effects of that One Big Beautiful Bill Act. It had a bunch of different tax benefits, and if you remember, I think it was Q3 of 2025, the net income was on the floor. That was because of that as well, and now they're getting a big tax benefit of about $5 billion. So we can see down here, it would have been $3.13 lower on the EPS side if this tax rate had not been in effect, or if they didn't get this tax benefit, basically. So back that out, and then so the true earnings per share growth rate is 13.6%, which is still great, but when you're growing revenue 33%, you'd like to see this higher. But something right now is a lot of these Mag 7 companies, and Meta specifically in this case, are investing so heavily in the CAPEX that their earnings per share, and especially their free cash flow, which we'll cover in a bit, is going to get hit fairly heavy in this early stage. So for anybody who's looking at investing in the stock, just keep this in mind, that there is a good chance that that can start declining just because of how heavy they're investing. So it's just something you need to be aware of as an investor and just keep that in mind. Because yeah, that revenue can accelerate, but they are also spending a lot of money, which we'll get into right now. Now, next thing that was also one of the downsides in the quarter. So the daily active people, 3.56 billion, it was up 4% year over year, but quarter over quarter, it was down about 5%. It was 3.58 billion in the previous quarter, Q4 2025. Now, they're saying this is due to internet disruptions in Iran, as well as the restrictions on WhatsApp in Russia. That's from what the company's saying. As for how much we know, we kind of just know what they tell us. Let's be honest on there. So that could be the case, and I want to have faith that that's actually accurate as to what's causing it. But still, it would be nice to know the breakout of some of these different platforms in their family of apps, their growth rate on an individual basis, because we know the total is at 5% decline quarter over quarter. But what if, let's say, maybe Threads we see was growing like, I don't know, 15% or something. The decline was coming from just WhatsApp, or maybe decline was coming from Facebook, something like that. Would be nice to just know those specific numbers, but either way, we want to see daily active people always continuing to increase. But while there is a bunch of conflict in the world currently, I can't hit them too hard on this. And at the end of the day, if you're still looking from a year ago, they're still up 4%, and they have half the world's population on their apps, on at least one of their apps, which is already a ridiculous number. The higher up you're going to get on that number of the world's population, the harder it's going to be to grow. So I'm still going to cut them some slack there. And for me, my investment in Meta has always been very long-term focused. And do I think they're just going to consistently go on a decline for the next 5-10 years, where now it's going to stay at 3.56 and it's going to go to 3.4, 3.3 5 years from now? No, I don't believe that. I think this is a short-term hiccup just based on some macroeconomic and conflicts going on in the world right now, but I don't think it's a long-term trend. I don't think it really has anything to do with the actual quality of the products they're delivering, which is why for me it doesn't really affect it. And I think the market isn't too worried about this as well. I think it really is this part at the bottom, which we're going to jump to. So their CAPEX was already insane last quarter. Let's just put it how it is. $115 to $135 billion a year. That is a ton of money to spend on CAPEX. An extremely ridiculous sum of money. And they raised it again to 125 to 145 billion, which is a lot of money. And unlike some of the other Mag 7, it's not like Meta has, a lot of the other Mag 7 have been able to get away with it because of multiple things. One, a lot of them have cloud businesses that are seeing the benefits of this instantly. Very high margin businesses instantly. AWS accelerating revenue. Same thing with Google's cloud side. Microsoft also with their cloud business as well. But with Meta, they are seeing benefit from it to improve the quality of their reels and their suggestions to make their apps more sticky and make ads that are more likely to convert. But it's not as direct as some of these other people are seeing with the actual data center build out. And I think right now the market is having a hard time wondering why they need to spend this much money. Like, obviously they're going to need high CAPEX for this AI build out, and I think that makes sense, but I think the market's really wondering, why does it need to be this high? 130, what's that? A 135 billion midpoint? That's just a ridiculous sum of money, which I can kind of see. It's going to hit earnings, it's going to hit free cash flow. But I'm two sides on this, because first point, okay, if it's actually genuinely they're seeing the internal metrics giving such a great return on the actual engagement on their platforms, I can see why they'd want to invest so aggressively. On top of that, I know the AI glasses have started to take off. So if they're looking at this from a long-term perspective of where we're using this infrastructure to improve the AI glasses, because we think these AI glasses have the potential to be a more mainstream product, similar to, I've always thought the AI glasses, if they got improved enough, they could be something of not a replacement for a smartphone. I don't think they originally, like a couple years ago, I thought maybe, but I don't think they'd ever be a replacement for a smartphone, but I think it'd start to be another addition to where now AI glasses or some form of wearable like that going forward is something you also have. So you have your phone, maybe you have, like I have this Garmin watch, and then now maybe you have some glasses as well integrated with that AI functionality. And then the AR, I think that's much bigger an opportunity. So if they're looking at that to where they're investing this heavy capex to put into those, that potentially could be a good return. And that's why I've always said, like, I'm giving Zuckerberg the benefit of the doubt, because he's proven in the past that he has a vision to make these things grow where other people don't see the potential in it. So that's where I'm giving it the benefit of the doubt there. Now, so main thing right here, takeaway, this is really why that stock price is down. It's this right here. And we're going to go through their free cash flow reconciliation in a bit and kind of see how much it's hitting their free cash flow. But on a positive note, good metrics. Ad impressions up 19% year over year. So they're showing 19% more ads, and the average price per ad they're charging is 12% higher. I think this just shows more proof that they're actually not only driving higher engagement, but the actual investments in the AI infrastructure is allowing them to push out more ads that are more targeted. They're converting higher, which means they can charge more because they're giving a higher return to their customers that are buying these ads to put on their platform. So I think that's a good sign, showing it's actually working. Next one, segment results. Reality Labs continues to go on an operating loss, burning $4 billion, and I'm always torn on this because I really do like Reality Labs. Well, I guess first let's start with the main one, the actual advertising segment. Of course, the family of apps still going strong, 41 billion to 55. Cash cow of the business, amazing. The actual operating income generated 21 billion to 26.9. Very healthy and strong. Reality Labs, it's operating at less of a loss, but still, it's like nowhere in sight to generate any operating income from this. And I'm very torn on this because part of me looks at it and I just think, okay, we could pull this 4 billion and just use it to keep the profitability of the company higher. So if they are gonna, it can kind of offset the heavy spin on this capex. But the other part of me also, I really do like their VR products, just as someone who's tried out the Oculus. My family has it. And then the AR segment is taking off. It is kind of just a high potential area where if they get it to catch on mainstream, this could be a huge growth driver going forward. But that's the thing. It's very, very tricky if it's actually how long it's going to take for this to actually pay off. And one thing I'd really like them to actually touch on this segment more in the conference call, because they hardly touch on it. They mentioned the AI glasses a bit, but I think we do need more clarity on what Reality Labs is working on, what their plans are for this segment of the business. Something like some companies do, like Adobe has their Adobe Max, or Zeta has their Zeta Now. I think we need like an actual like Reality Labs day or something for Meta, where they kind of go through different products they're working on or different things they have down the pipeline, and something to just kind of give more clarity on where exactly this money is going to. Because we obviously know it's going on those AI glasses and improving the Oculus, but I don't know. I feel like we don't have a clear vision of where this is going to be 4 or 5 years from now, what the long-term goal is. I, as an investor, I'd personally like to know that more deeply. If they are going to continue to run this segment, it's going to burn so much cash. At least just give us more clarity so we can understand it more, or we have a bigger, clearer picture on what the long-term goal is. Because right now, they barely touch on it on the conference call. when they do, Zuckerberg kind of always gives the same answer of, oh, we're looking more long term for this. Is something like thinking like growing the future. He's kind of very vague on it. And I think we just need more clarity. And I think just give us something more to chew on, because there's not a lot given. Now, here we go on to CAPEX. So we see they went from 13.6 to 19.8. Ridiculous. About like what's that? Like 6-ish, 6.3 billion quarter over quarter. And then 2024, they spent 40. They're nearly double 2025 at 72 billion. And now they're increasing it for their midpoint of 135 billion, which is going to be about a double up again. Which this is what the market's looking at. They're going, okay, he's spending this much, you're doubling it again. And you can't really blame them. It's people looking at this and going, okay, next quarter or next year, what are we going to up this to like 150, 160? Like at a certain point, it only makes sense if they're starting to get the return, which they're seeing some improvements. So we need that acceleration a lot higher if you're going to be spending this much. We need more acceleration. I know 33% is a lot, but we needed to start pushing like 35, 36, maybe even into the 40s. If you're going to be I'd say, yeah, we need to start getting to the 40s. If you're going to start pushing the amount of CAPEX this heavy. And it's just one of those things where the market's not going to like that. They're not going to enjoy that. Now, family average revenue per person. We can see this is up 26.7%, which is great. So on each user, they're making more money. Awesome, 26.7% year over year. Next one over here, ad impressions delivered year over year percent change. Something I wanted to highlight here was more of Asia Pacific and rest of world region. We can see 23% more ad impressions year over year and 17% over here rest of world. Europe as well, 17%. So that's actually some pretty strong growth. And yeah, that's just gonna, these other segments outside, I know people usually focus on US and Canada because that's more of like the most profitable, but long term, as these countries continue to develop farther, that's going to be more money and more growth vectors for the company. So this is really great from a long term perspective as they continue to scale over there. And then as we can see with even the average price per ad, so Asia Pacific, not too great, but if we're looking at Europe, up 19% more average price per ad, and rest of world up 18%, which we really like to see. So they're starting to show more ads in rest of world, and they're starting to be able to charge more and more, which I believe they'll be able to continue to do for years to go into the future, which is just going to help drive farther revenue as they continue to scale and monetize that out, which has kind of always been Meta's game plan. They try to scale out, even if it's a new product, entering a new region, keep the ads low, not a lot of monetization, just scale, get everyone onto the platform, get everybody to start enjoying it, using it, then slowly start rolling out a bit by bit, and just start ramping till you finally get to a more mature area like US and Canada. That's always been their game plan. Now, this one I wanted to touch on because as we can see, we talked about earlier, almost 19 billion in CAPEX. A year ago, they were doing 12.9. 1 year before that, in 24, they're doing 6.4 million. So how does this translate? So we're doing 20 million in cash provided by operating activities, about 20 billion. We have about 12 billion more 2 years later, but we have less free cash flow. We had 12.5 billion, and now we're at 12.3 billion within a 2-year span. The market's not going to like that. And yes, we're up 2 billion from prior year, which is good to see. But that's only because of that increase. That's only because this year had a huge decrease going to this year. So it made it an easy comp. So it's like, okay, we grew 2 billion on a year over year, but you look 2 years back, we had more 2 years ago. And it's like, look at this. We went from 6.4 to 12.9. We basically doubled. And then we increased it about another 6 billion. And then we don't know how much more they're going to continue to keep increasing it. And that's really where the uncertainty of the market is actually coming in. And they're going, hey, what's going on with all this spending? But with that being said, like I've kind of clarified, I'm having more leeway with Zuckerberg just because he tends to be right on these things in the long term. Now, here are some points I took directly from the transcript on the conference call. There are a few things that I just wanted to touch on that I thought were interesting or that stuck out to me. So we're talking about those AI glasses earlier. They continue to perform well, and then with the number of people using them daily tripling year over year. So that one I just wanted to touch on right there, because this is kind of going into my thesis earlier, where if they can accelerate these and these become the next large wave of technology that people have, so they have their phone and now a lot of people are starting to get AI glasses, this can be a huge revenue driver, not only for the initial sale of the glasses, obviously that's going to generate some, but I think longer term, because obviously they're going to start integrating not only their apps in there, but they're going to start monetizing when people are wearing the glasses, either from ads in there or any different type of software. So that's going to be a lot of monetization they're able to get from that as well. Now, Instagram ranking improvements that we made in Q1 drove a 10% lift in real-time spent. Reels are driving more engagement. I'm sure y'all have noticed this if you used Instagram. That stuff is addicting, which is great for Meta, at least, because more engagement, more people spending time on the platforms, you can put more ads in front of their face. They're more than likely to buy from these ads, and so they can charge the advertisers more because the advertisers are making more money from posting ads on any of their family of apps. Now, Facebook total video time increased more than 8% globally. Same thing there, where we just want more engagement because they can put more ads in front of people, generate more money. And then within the US and Canada ranking improvements, we made a 9% increase in video watch time on Facebook in Q1. Now, this is important that this is growing faster than globally for the main reason because US and Canada always charge higher price for ads. The price for ads US and Canada are much higher than globally. So this is going to be way better for actually hitting that top line revenue growth. No. Now, those are the things I kind of wanted to touch on here. So closing out the video, stock is down mainly because of that CAPEX. And something you just want to keep in mind is how quick the market can switch on a dime. Like literally we can be a couple, like 2 quarters from now and Zuckerberg can say, all right, I think we're going to start slowing down on the CAPEX spin. We're going to start trying to keep it steady. And I guarantee you, like that, the stock price would flip in a day. It would go crazy. So just something to keep in mind there. Short term, it could be ugly just because the free cash flow is going to get hit. And so is the net income with all the depreciation hitting the expense line for all the depreciation expense. But at the same time, I think right now, your best bet is valuing these companies on an operating cash flow basis. And that's how you're going to have to look at long term. If you look at some other companies that always had heavy CAPEX investment, like in Amazon, price to operating cash flow is always the best way you could base your valuation on it. Me personally, I've always held this company as very long term. Like I said, I have over 30 shares of it. I also have a small amount in my retirement portfolio as well that I add. So my retirement portfolio is mainly made up of index funds, but I do have some Meta I also buy consistently monthly. So while I won't be adding to my position just because I'm already so heavily invested in it, I will still be adding the amount I add into my month or into my retirement account. But in terms of my main portfolio, I won't be adding. I also will not be selling. Meta's always has been my core position because I do have a lot of conviction in this name, and I do think long term they have the makings to be the largest market cap company in the world, just with the trajectory of not only their revenue growth, but also in terms of how profitable and scalable their business is. I think a lot of these problems they're having are more short wind, and long term they're going to be kind of smoothed over. And the other thing is, I don't think the valuation on the company is even particularly high right now. So I will continue to hold my position. However, if let's say I did not have my position in Meta and I had no shares, I would probably be looking to pick up. And in fact, whenever it was in the 500s a couple of weeks ago, even though it was my largest position, I was accumulating not a lot of shares, but I was putting, like a couple $100 here and there. let me add a little bit more to my position, stuff like that. But yeah, I'd be adding this position if I wasn't already so heavily invested in it. But no, I will not be selling any of my position. This remains a hold for me. I will continue to just watch how the quarters unfold, and I'll be a happy investor. So I hope this was helpful for anybody looking at the stock. And if you're looking for any other earnings that I have covered this earnings season, currently I have a video before this one where I covered Zeta Global. That one's a very interesting one. I see a lot of similarities with Palantir on that one, AI data marketing company. Very interesting. I recommend you looking at that video or the video I did on their moat as well, if that interests you at all, and just taking a look at it. I will have later today coming out the SoFi earnings. I'll cover the SoFi earnings and go ahead and get a video out on that one. And then we'll see if I'm able to do the Amazon, because running short on time, but I'm going to try my best. If not, for sure that SoFi earnings video is going to be out today.